You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. All right, we are taping Options Playbook Radio on 4/20, one of Elon Musk's favorite days of the year. At least he likes to joke about it. And we do have the markets going a little crazy today. Netflix announced earnings last night, and their stock is, let's just say it's getting beaten up. They're calling it the Great Cancellation, and that's in regards to Netflix subscribers. Right now, as we tape Options Playbook Radio, the markets are open. They're rocking and rolling, and we see Netflix is down 31%. Down 107.38 on the day. So that would definitely hope, if you own Netflix, that you were able to drink at least 1 or 2 cups of coffee before you got a quote on the underlying stock. And we're going to do a play off of that. Now, normally on Options Playbook Radio, we would begin by talking about last week's trade, but we were able to do a huddle up last week. That's when Mark and I get together and answer some listener questions. Mark Longo, you may have heard of him. He is the founder of Options Insider Radio, and had some great questions last week. So we're just going to, if you want to hear about it, we talked a lot about skip strike butterflies and different things to do around earnings, and we're still in earnings season, as we mentioned Netflix. And we still have some of the FANG stocks that are going to be reporting. Netflix usually kicks off that group of stocks. And so today, because of the big downturn in Netflix and a lot of the companies that provide streaming, we're going to talk about Disney. And I didn't plan on talking about Disney until I saw the fact that Disney was down 4% today. And they're going to be announcing earnings in May. So May 11th is the date that they're expected to announce or anticipated to announce. And we're going to do a calendar spread. And mainly because, you know what, on Options Playbook Radio, we have many, many different episodes. I try to change up the strategies as much as possible. When I saw that we had quite a few days, 23 days until the expiration that would contain that earnings, I decided that let's do a calendar spread. Let's go out and we're going to sell some of the short-term premium that has obviously spiked because of a 4% downturn that is basically caused because of Netflix. And then we're going to go out a little bit longer, and we're going to buy the longer term expiration, which we still anticipate vol to go up on as their earnings announcement approaches. And we're going to do a calendar spread. So in the moment, this trade I thought would be something exciting to talk about. Now, as always on Options Playbook Radio, nothing is meant to be a recommendation. And we're always just trying to fit strategies into certain situations. Inside the Options Playbook, there are over 40 different strategies. So we get creative on different underlyings. So there is no golden book of answers as to what is the best strategy. It's literally, in my mind, the best strategy is the strategy that fits the conditions of the marketplace. And right now, this fits the conditions of the marketplace. Now, obviously, you have to be a little bit bullish on Disney if we're going to do a bullish trade, which we're looking to do today. So we're going to do a calendar spread, otherwise known as a time spread, also referenced inside the playbook as a horizontal spread. There are many different names for it. And we're going to use call options, and we're going to say, well, you know what? Disney is not Netflix. And if Netflix is losing subscribers, maybe it is because of Disney. And we're hoping that we can get a little bit of a bounce back after this big downturn that Netflix is basically dragging the whole NASDAQ and all of these companies downward today. All right, so let's get into the strategy. It's going to be a short and sweet Options Playbook Radio today. And here we go. So right now, I'm going to take a snapshot of the market because the markets are rocking and rolling. I see Disney down $6.80 at 125.10. We are going to do a calendar spread. All right, so because Disney's going to be announcing earnings on the 11th, we're going to be targeting the May 13th expiration. We're going to be buying the option contract that expires after the earnings date. So we are going to be buying the 132 strike call, which is basically where Disney was this morning before it opened down. Well, I should say on the close last night. So we're going to buy that May 13th 132 strike call, and then we're going to sell the April 29th 132 strike call. Now, important that call option has premium in it. It's trading at about 30% implied volatility because of the downturn. And we're seeing that option contract on the bid trading at 53 cents, on the ask trading at 61 cents. A little bit wider spread than normal than you would see in that option contract, but that probably has a lot to do with the volatility today. There's also a lot of options being traded today because of the downturn once again. And so I do think that a midpoint fill is possible. It's never guaranteed, but it is possible. The option contract that we're buying is trading at about 39% implied volatility. And that's not unexpected because that does contain the earnings. And that's a whole reason why we like to do calendar spreads around earnings. Is one of the biggest things that you have to deal with when you're dealing with multiple expiration dates is the fact that implied volatilities have a tendency to fluctuate a much differently between the expiration dates. So we want to set up a situation where we think implied volatility on the back month, the longer term option that we're buying, could potentially go up, where on the front month we might expect it to go down. So that is what we're setting up. So around known news events is when I like to target things like diagonals and look at a calendar spread or a time spread, or also referred to as a horizontal spread. All right. So on that trade, buying the May 13th expiration 132 strike call, selling the April 29th expiration 132 strike call, we're able to get that trade done, hopefully near the midpoint of $1.83. So for every 1-by-1 spread that we would be doing, we would have a total cost of $183 plus commission on that trade. if we get out of the trade or basically close it out before the first expiration, we don't end up buying the stock overall, then that's going to be our maximum risk. $1.83 is our maximum risk, which is the net debit that we paid for the trade. So if we do this, what we would like is a bounce back in Disney back to the 132 level. Now, I also approach this as maybe this is a way that we could get long a Disney call option. We are obviously bottom fishing here. Disney has had its struggles. So Disney hasn't really made the bounce back since the upturn in the market since the pandemic announcement and everything else that has happened in the marketplace recently. So Disney's had its struggles. So we would be bottom fishing here. We don't want to risk a lot. That's part of the reason why we're going to be using out of the money option contracts, and we're going to be doing the trade this way. So once again, we're in a situation where we wouldn't mind taking a risky play on Disney going into earnings. How are we going to do that play? Well, we're going to go and set up a scenario where we're going to try to take advantage of the short-term volatility. We're hoping that it's not as bad as everybody thinks it is today. We get a little bit of a bounce back in the short term. That doesn't hurt us, but it allows us to get long an option contract that we could ride into earnings if we would like. I would never buy the 132 strike call outright, knowing that Disney's going to be announcing earnings when that option contract is so far out of the money and so pumped up with implied volatility. If we were going to just do Disney earnings and that's all that was happening right now, we'd probably go to either the long butterfly, and if we're bullish, we're going to do calls, or the long call spread and ride that into earnings. So there's a lot of potential with this trade. One thing that we can be a little concerned about is that it bounces back too fast. We don't really want it to shoot through the 132 strike before that April 29th expiration. Ideally, it would just kind of stay here. Balls would come off on the shorter term, and it would slowly start moving back towards the 132 level. That would be our best case scenario here. So we are going to do a long calendar spread on Disney. We're going to be buying the 132 strike call with the May 13th expiration, selling the April 29th call with the 132 expiration, doing this for a net debit of $183 at the midpoint, or $183 plus commission to put on the trade. That is our maximum risk on the long calendar spread with calls. And if we get to the first expiration, the April 29th, and the stock hasn't came back to the 132 level, we could also sell. There's another expiration. We could go out to the next expiration 1 week out and sell another call against it. There's just a lot of possibilities with this trade. Now, if the market does continue on down, we limited our risk by doing the long call spread, 183. So we always have a chip in a chair in that Disney can announce earnings and anything crazy can happen on earnings. We see Netflix down 31% today. So there's always a chance that even if the stock does go down, that earnings could drive Disney higher. Maybe a lot of those subscribers left Netflix and went to Disney, and we see just get a pop like that. I'm just trying to paint a scenario that could be good overall. So if you're doing this trade and it is your first time thinking about calendar spreads or long call calendar spreads, you definitely want to do this on paper. As we always say, we're just trying to learn here on Options Playbook Radio. And you want to really pay a lot of attention to how the implied volatility on the front month reacts relative to the implied volatility on the back month option contract or the longer term expiration, because that's the whole moral to the story. That's why we're doing this specific strategy on Disney. And when we come back next week, we'll have something to talk about because we have a longer term expiration. We'll see where this is trading at and maybe even look at an adjustment based off of where the current marketplace is at. All right, that's it for this edition of Options Playbook Radio. If you have any questions you would like us to try to address on the show, please email them to me at theoptionsguy@invest.ally.com. If you want to learn about all of the events that we do at Ally Invest, all the educational events, please follow me on Twitter. My handle is simple. It's at my name, at Brian Overby. And thanks for listening. Until the next time, may all the options that you sold finish out of the money and all the ones you bought finish in.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.